Today we're looking at an outline for a video segment on Strive Inc., ticker ASST.
Yeah, this is a hot one. It's about that recent 10% pop, the short squeeze talk, all of it.
The material's definitely strong, but we're going to jump straight into some structural feedback to really boost the clarity and, maybe more importantly, audience safety.
Absolutely. I mean, the writer has all the right pieces here. The volume, the short interest, the Bitcoin connection, it's all there.
But with a topic like this, how you sequence the information isn't just about good storytelling.
No, it's about protecting your viewer. It's about liability, really.
Exactly, which brings us right to our first major point. That crucial warning about the preferred stock dividend, it needs to be moved way, way earlier. It has to be emphasized right at the top to meet the audience's safety needs first.
Yes. The outline calls it the dividend trap, which is the perfect name for it.
It is.
And this is the core of the issue, right? That $1.13 dividend is for the SATA preferred stock, not the ASST common stock everyone is trading.
And if your video title is something like ASST stock exploding, you know every single retail trader clicking that is hearing $1.13 and immediately doing the math.
Oh, for sure. They're multiplying it by how many shares they want to buy.
So the weakness here, and it's a big one, is that the outline buries this warning deep in the second segment. It's like 4 minutes into the video.
Which is way too late. If your hook is good, you've got them excited, but you're letting them get hyped up on a false premise. You risk them tuning out, or even worse,
Acting on that headline, exactly, before they even get to the part that says, hey, wait a second.
that delay, I think, it kind of compromises the whole piece. So the suggestion has to be about making it immediate.
So you're saying we have to pull that dividend confusion explanation out and make it a primary focus, like right after the hook.
Right after the hook and tease. No delay.
Okay, let me just push back on that for a second, just to play devil's advocate.
Go for it.
If the goal is high energy, high engagement, doesn't leading with a big warning sign sort of kill that initial momentum? How do you balance being safe with keeping people watching?
That's the thing. You don't sacrifice the hook. You weaponize the confusion. The confusion is the hook. Think about it. Why is the volume so high? Why did it pop 10%? A huge part of that is probably retail traders misunderstanding this exact point.
So you frame it as a mystery.
Exactly. Frame it as the secret the market isn't telling you. It's actually more engaging than just another short squeeze tease.
I like that. So instead of don't do this, it becomes, here's the #1 mistake people are making with this stock, and here's how you can avoid it.
Precisely. So for a concrete example, you could restructure that opening tease to say something like, today we're breaking down why ASST is exploding. But first, we have to talk about the massive confusion around that 113 dividend. Don't even think about buying this for a payout until you understand the difference.
That's really strong. It builds immediate trust by putting the viewer's interests first.
And if the writer really wants to keep the squeeze analysis up front, there's another way.
What's that?
You could do your short squeeze verdict in segment 1, but then immediately right after, you drop in a short, punchy segment. Call it Investor Alert, the ASST dividend trap explained.
So you get it done before the 4-minute mark, before you get into any of the other bullish ideas.
Yep. Either way, moving that warning to the top just elevates the entire analysis.
Okay, great point. So let's shift from safety to the market mechanics. This is our second critique. To really serve an expert audience, the distinction between a classic short squeeze and a gamma or momentum rally needs to be defined much more clearly and tied to the data.
This is where we go from just describing what's happening to explaining why it's happening.
And the material is good here. It correctly points out this isn't a GameStop situation.
Right. It uses the right numbers. The days to cover is super low, like 0.66, and the volume is huge, over 80 million shares. So shorts are not physically trapped. They can get out if they want to.
Agreed. But then the outline just pivots and calls it a gamma squeeze or momentum rally. The weakness is that it says the 13% short interest is good fuel, but it never actually explains how that fuel feeds the engine of a gamma squeeze.
Yeah, the concepts are just sitting next to each other. They're not connected. There's a causality gap.
Right. And we need to fill that gap.
A gamma squeeze is all about options activity, right? It's market makers having to hedge. A classic short squeeze is just shorts being forced to buy back shares directly.
So the suggestion is we need to draw a straight line from that 13% short interest to the options activity that drives the gamma event.
Exactly. We need to explain how that pool of shorts, even though they can cover easily, still adds this massive upside pressure if and when the price moves past certain levels.
So how do you make that tangible for the audience? Because that 13% is just a number until it turns into actual buying. Is it instantaneous?
No, not at all. And that's the key. It's a cascade. So you'd explain it in sequence. You start by saying, that 13% short interest is the fuel.
Okay.
Then you clarify. The shorts aren't trapped yet, but they're the accelerator. So if retail and institutions start buying and push the price past a key option strike, let's say $1.20,
Then the gamma part kicks in.
the gamma part kicks in first. That's the market makers being forced to buy shares to hedge their call option exposure. That's the initial shove. Then that high short interest acts as a secondary, guaranteed wave of buying that gets triggered because the price already moved.
Ah, I see. So the shorts aren't the trigger, they're the rocket fuel that makes the initial trigger so much more powerful.
That's it. It explains why a gamma squeeze on a stock with 3% short interest is a dud compared to one with 13%. That 13% guarantees the momentum has legs.
It turns it from a static number into a dynamic threat hanging over the market.
Exactly. So to wrap that point up, you could rephrase the verdict. Something like, the verdict. This isn't a traditional squeeze. It's a gamma and momentum event. But that 13% short interest provides a huge, guaranteed wave of buying the second that 120 ceiling breaks.
That level of detail is what the target audience is looking for. Okay, so we've handled safety, we've clarified the mechanics. Let's hit the final point, narrative. The technical analysis, the price targets, should be woven directly into the discussion of the catalysts.
Yes, to show how the big picture drivers and the trading levels interact in real time.
Because right now, the outline just lists the technicals in their own little section.
Yep. Segment 3. Current price, 113. Ceiling, 117 to 120. Floor, $1. It's just a list, and it feels completely separate from the Bitcoin story or the institutional whales.
The data's fine, but there's no causality. The viewer has to connect the dots. Like, why does Citadel buying matter for the $1 floor? When does the Bitcoin move actually break that ceiling?
By separating them, you lose all the urgency. So our suggestion is simple. Merge them. Use those price points as the finish lines for the catalysts you're describing.
Okay, let's make that concrete. The Bitcoin connection is huge for ASE. The outline notes Bitcoin went from 81K to 87K, and that's what drove AST up to 113.
Perfect. That is the exact moment you bring in the ceiling.
How would you phrase that?
You'd say something like, so that jump in Bitcoin pushed ASST right up to 113. Now, the key thing to watch is if Bitcoin has enough strength to push ASST through the critical $1.20 ceiling, because clearing 120 is what opens the door to that 145 gap-filled target.
I love that. It frames 120 not as just a line on a chart, but as a real barrier that the Bitcoin momentum has to smash through. It makes the chart a battlefield.
A battlefield, not a static graph. Exactly. Now, let's do the same thing for the institutional buying.
Okay, the whales. The outline mentions Citadel, Jane Street, they bought a ton in Q3.
And the most important downside level is the $1 floor. So you connect the two.
How do you frame that floor as, part of the whale story?
You frame it as their line in the sand, their psychological barrier. So when you talk about Citadel, you pivot right to the floor. You say, these big institutions bought heavily in Q3, which shows real conviction. That makes the $1 floor absolutely critical. That's the level where they defended their thesis. If Bitcoin dumps and we lose $1, that's not just a technical breakdown.
It's a signal.
It's a signal that the smart money might be heading for the exits, at least temporarily. And that could mean a quick flush down the 90 cents.
That makes such a huge difference. Losing $1 isn't just a support line breaking, it's the potential abandonment of the institutional thesis. It's so much more compelling.
At the end of the day, weaving it all together helps the viewer see the market as this unified system where everything interacts, which is, what they're here for.
Absolutely. This has been a really sharp critique. So to recap the 3 big takeaways for the listener, first, get that dividend warning up front, immediately after the hook. Make it a primary alert for safety and for impact.
Second, go deeper on the squeeze mechanics. You need to clearly explain how that 13% short interest acts as secondary guaranteed buying pressure that gets activated by the gamma hedging. Link them together.
And finally, integrate your key price targets, that $1 floor and the 120 ceiling, directly into your discussion of the catalysts, like Bitcoin and the institutional whales. Use those levels to create the narrative tension.
Yeah, these changes will really transform the outline. It'll make the final video safer, much more authoritative, and just way more dynamic. We definitely encourage you to make those revisions and send it back in for another look.
Until next time, keep refining your work.